Hey folks, thanks for joining me. We have a house full in here today. So I think a lot of people were wanting to know the same question. When will rates go to 5%? So that's what we're going to talk about in today's video, folks. So thanks for joining me today. If you guys would, like I always ask you, just please give me a thumbs up if you can hear me okay. All right, so what we're going to talk about today is where rates going, and are they going to get to 5% anytime soon? Let's go. We got Antonio joining us. Thank you so much. Good afternoon. So are rates getting higher or lower? Let's answer that question for you. So let's get over to what we're seeing right through here. So this is the question that we keep seeing is when will rates go down to 5%? Now this was just posted August 6th, not too long ago. Now people are getting greedy. Remember those pigs get fat, hogs get slaughtered thing? Well, now people are saying, well, when rates going to go to 3%? Well, this was posted just the other day. Oh, what is today? The 14th or 15th? That was yesterday. Okay, so that's what now they're asking is when will rates go to 3%? But for those out there that follow me, well, let's answer the question because I was actually in Yahoo Finance not too long ago, and they called me asking me this exact question. So if you go to Yahoo Finance, and I forget when this was, right up through here, when was this? On July 31st, I had actually Yahoo Finance contact me, and they're like, Dan, we've seen you on News Nation and all these other places. What do you think is going to go on with rates? So, folks, that's what we're doing today in today's video. So let's get over to what we're thinking and what the thoughts are. Okay, so when are we going to get to 5% rates? Not anytime soon that I think of. But I do have this to say. I just pre-approved a young lady who was putting an offer in on a house actually this evening, and I got her approved with an FHA loan. And I haven't seen this rate in a long time, but I was able to get 5.99. It's FHA, so it's hard to determine the APR and all that stuff, but we are getting rates into the 5.99 ranges, folks. But today's PPI number, the producer inflation, that's what starts shocking me. So let's determine what factors go into, producing these rates. So let's get over to it. What I want you guys to understand is why we go over all these data points every day when I go over rates with you and the whys behind it. What you have to understand is the dynamics behind what creates that mortgage rate. It's not like the banks come up and say, okay, today we're just going to put rates out here. These are all the dynamics behind the scene that the markets follow because mortgage rates are connected to a mortgage bond. So here's what we want to follow, and I'll give you all the projections in here. I did an analysis of, what we're going to look at, and then I did another analysis of right through here, some examples of where the spreads are, and I'll make all sense to you. And I'll also explain to you guys one of the big reasons why Trump right now is really all over the Fed, talking about they got to drive down this rate. So hopefully it all ties together at the end of this. So again, folks, I would ask you if you can hear me and see me okay. All I ask you to do is just click something. You can up button an A or whatever, but let's get to it. All right, so here's what we want to focus in on. So this week, we can tie in some of the data that came in this week. So what we had this week is the CPI number come in. That's consumer inflation. Well, let's first roll over to this. The Federal Reserve, their role in all this is they focus in on these two things right here. That was why they were created. They were created for the price stability, which we call inflation, and unemployment. They were supposed to keep the employment numbers at the maximum. Okay, so that's what they control, or that's what they monitor. Then they control the federal funds rate. This is the interest rate that they control, and all this rate is basically interbank lending. So if one bank at the end of the night, here's kind of how it works. One bank at the end of the night, they have to have $1 billion in assets to close for the day, so they're solvent. And they're short. So they go to this and they're like, okay, we need funds overnight. And they say that's the rate they pay. But all short-term maturities on loans, like car loans, personal loans, and things like that, are kind of tied to that, or that flows through the system. And I'll explain to you. The federal funds rate, as this moves up and down, banks will also move their short-term maturity loans up and down, car loans and things like that. But you have to understand the mortgage rates are tied to a bond. And it's this bond right through here. It's an MBS. So what's all the historic data used to come in and tell us is, you need to follow the 10-year Treasury. So I'm just trying to lay the foundation of the terms that we're going to talk about in today's talk. So we're going to talk about MBSs. This is a mortgage bond. This is basically how mortgage rates are created. The 10-year Treasury. This is Treasury bonds or our debt that our government issues and investors can buy. And here's the yield. So if you bought a 10-year Treasury today, you get a yield of 4.29%. Pretty good. So this is what we're going to focus in on. So let's get now back to this equation here. Okay, so how all the bonds and the markets really work is they focus in on this data here. They focus in on CPI, which is consumer inflation, and then the PCE. That is that's the inflation numbers that the Federal Reserve monitors. Okay, the CPI number came in this week. Remember, I think it was Tuesday it came in, and it came in 0.1 less than where we were previously, and the markets loved it. The stock market rallied, everything was good, rates came down. But then what we got is the PPI number. That's producer inflation. So let's move down through here so we can understand each part of this. So again, CPI is consumer inflation. Core CPI basically is this. It removes food and energy to filter out short-term price swings. But it's the same thing as the CPI, but it extracts out food and energy to kind of stabilize things. And then the PCE, this is the personal consumption expenditure that the Federal Reserve monitors. And again, I want to keep track with these for you. So it's right through here. All right, PCE, that's the inflation figure that they monitor. Okay, so we go back through here. The PCE, that's what we're looking at. So we were going to follow those things. All right, I'm getting somewhere. Why these metrics matter to the mortgage rates. Well, headline CPI informs how inflation is behaving month over month and can immediately affect bond yields and thus mortgage rates. Okay, core CPI and core PCE helps the Fed determine its long-term policies. If core inflation is falling toward or below the 2% target, well, increased chance of the rate cuts. Okay, but the PPI, while no direct inflationary headlines, PPI tracks wholesale prices and can signal future consumer inflation. A surprising spike in PPI can reignite inflation. Well, what did we get today? We got the CPI number come in the other day, and it came in okay. We got the PPI number coming in today, producer inflation. That's the first piece of the puzzle that's going to start showing the tariff news. It was up 0.9 in 1 month. So now you're thinking, that came in today, folks. So I thought when I woke up this morning, I saw the print. Well, after I got up, I saw the print. I'm like, man, the markets are going to crumble. Stock markets are going to crumble today. Mortgage rates are going to skyrocket. And, stock market was down a little bit, and mortgage rates didn't really move. And I'm like, this is confusing. So let's continue to roll on through here. So we're going to go through here. Recent U.S. inflation readings is this. The July reading was 2.7, slightly below forecast. Core inflation around 3.1 year over year, still above the 2% target. So we know, this is in there. But now here's the thing. PPI up 0.9 month over month, making the biggest increase since mid-2022. Your year over year PPI growth is 3.3%. So let me break this all down for you. Here's how a lot of this works. So we're going to focus in on the Treasury yields and the federal funds rate. And that's how we're going to focus in on that. So the federal funds rate is controlled by the Federal Reserve. So we know, or we've heard this week, that there's a lot of new Fed officials on the charts to become the new head poobah at the Federal Reserve. But now they're starting to descend. So it looks like Jerome Powell, who's the head of the Federal Reserve, he's not looking to cut rates. Now we had at the last meeting 2 people looking to cut rates, and now there's probably going to be a 3rd person added here soon saying they need to cut rates. So is that going to bring rates into the 5s or the 3s? No, not anytime soon. Let's get over and look why. Historic spreads, mortgage rates are usually about 1.5 to 2% higher than the 10-year Treasury yield. Okay, so let's roll over to this. So this is where the government right now, there's kind of a yin and yang to this. Okay, the Federal Reserve, they're controlling kind of the front end of the yield curve. Now, the federal government, with their spending habits and everything, they're going to basically control the long end of the Treasury yield, because the more demand for something, the lower the prices and the higher the yield. Okay, so if you have less bonds hitting the markets, that's going to create, basically security in the bond markets, and that'll bring down yields. Okay, so as the Federal Reserve reduces their spending, think of it this way, rates are going to get better. That's kind of a roundabout way to look at it. It doesn't look like they're going to cut spending anytime soon. The tariff news is a smokescreen with a lot of this. Doesn't look like the Federal Reserve's cutting anytime, or the government's cutting anytime soon, because we just had numbers out recently, and those numbers are not good. So here's the lesson I want to explain to you guys. You're going to watch the 10-year Treasury because it's well accessible. But if you've been watching the news, Secretary of Treasury Besant, he keeps coming out, and their goal is targeting the 10-year Treasury and just driving down that yield. And as you see that happening, you'll see rates coming down. But until tariff smoke screens get away from us and all this other news and just a bunch of stuff in the background, the markets aren't going to stabilize. So let me show you my thoughts on this, and I'd love if you guys can contribute to this. Just let me know. But so let's go over to the charts that we go over on a daily basis. So when you join me each morning and each evening, here's what we talk about. We talk about the MBSs. But a lot of people don't have a clue. Even in my business, you'd be surprised that people like MBSs. Well, I just track the 10-year Treasury. And I'm like, dude, you're cool. You're good. You're good. Just do what you do. So here's what we're looking at. The 10-year Treasury right now is trading at a 4.29. Well, we know the multiple over history right through here is 1.5 to 2% higher. Okay, so we go to that, and let's say we add 1.5 to 2% to that. Let's say the 2%, it's simpler. So at 2%, that's the high end. We would be at 6.29%. Where are we? Okay, so it's even higher than the norm that we're seeing right through here. So the good news behind a lot of this, you see how the high end of this trading post is 2% above the 10-year Treasury. Okay, so again, let's go back to the 10-year Treasury so we can make sense of this. 10-year Treasury is 4.29. The high end of that is 2%, which would put us at 6.29. Why are we up to here? That's additional risk in the markets that we're seeing right now. People are reluctant to buy mortgage bonds and so forth. So that's what's causing things to be this escalated. So if we can just take out the risk premium, for example, we get some certainties on tariffs. And, whatever direction or whatever side of the political party you're on, it's confusing as hell. I got a bunch of neighbors. I have a new neighbor that just moved in, and he's the head buyer for Aldi's. And it was like, man, I'm like, you're the perfect person to talk to because I can talk to you about tariffs and things like that. So I have an appointment with him. He's my neighbor, so I don't have an appointment, but I'm going to be hanging out with him over the weekend, just kind of, asking him about these things. Is there an end in sight? Because once we know the tariff news and once all that gets built in the system, now at least we have the data that we can hopefully extract out even the risk premium built into this. It's at least 0.25% higher in here. So if we can just take out the risk premium on that from tariffs of here, and this is my thought, folks, you're going to get a 6.25. My goal for the year has always been 6.5, and I'm not going to teeter from that. I'm not going to come back now and say, well, now it's going to be 6.25. I'm thinking we're going to stay in this range for a while. So until we get tariff resolution, and most people are saying it's going to be 3 to 6 months still because we still don't have an agreement with China. So until the China trade really gets resolved, we don't know where all that's going to go. And the reason why I keep bringing that up on a daily basis is it all plays a role in all the markets that we focus in on. So once the tariffs get resolved, there's always going to be issues. One party anymore just hates the other. So there's going to be issues. There's going to be smoke screens in front of it. We need to focus in on really what we need to what's going to determine these things through here. And it's all going to be government spending, which we're hoping it's going to come down, and hopefully the tariffs start really driving that down as well, because tariffs a year ago today, the average tariff was 3%. Currently it's 18%. So there's a 15% adjustment in there. But you got to think of it, and like I always try to do, think of this as the glass half full. Think of the money we're pulling in from this tariff revenue. Now, I know what you're going to say. You're going to say, Dan, it's paid by the consumer. I would agree with you. I'm going to come out on a limb and say, I agree with you. Not all the time, because some companies, like when we see massive price increases to things, we can't just say go out to you guys and say, and if it's for our company, I can't go out there and jack my rates up real high to offset that because you won't use me or my products. So then I won't do any sales. So I hope you understand how a lot of these things work. So we're going to focus in on is consumer inflation. Okay, as it's coming in. The Federal Reserve and everybody wants it at 2. I'm saying it's at 3. So, but the good news about that part is we'll go over to here. I'm saying the inflation rate's at 3. I think a lot of economists are saying the current inflation rate is 3. Let me know what you think up there. Put in 2, 2.5, 3, 4. Don't put in 20. So as this starts to drive down, if this goes down at the next meeting, let's go to the CME FedWatch tool. I'm going to pull that up here. So let's go back. Let's now go and project where the federal funds rate per the CME is supposed to be next year. Okay, so let's go back. In 33, the CME FedWatch group, hopefully a lot of you guys know that we use this and how to use it. You can just go to CME FedWatch group. slash markets slash interest rates. And you'll find this. It's basically a tool that was created to give us kind of up to date on what the Federal Reserve is going to do with the upcoming meetings. So you go down through here, and I want to explain to you how this works. So just go to probability. This is the easiest way to explain it. So now here's what you're looking at. All right, so across the top here, it gets a little confusing. It says meeting date. Well, that's the dates down through here. So let me blow this up a little bit so you guys can see it a little bit better. That was a little too much. Okay, so down through here is the meeting dates. All right, across through here is the federal funds rate. Okay, you can see right through there, 4.25 to 4.5. That's where we are now. So they're saying at the September meeting, there's a 92% chance that the Federal Reserve is going to cut. How do you know? Because we're now in this column. Okay, the column of 4 to 4.25. Well, that means they're going to cut a quarter. Now, they're saying the next meeting, they're going to cut a quarter again. There's over a 50% chance. So we have now 2.25% cuts that are projected from the Fed. So that's a 0.25% cuts. So now let's go back and see where we are. So if they bring this to 4. Okay, that takes a 0.5% out of these. Will it take a 0.5% out of mortgage rates? No. It's not going to have a one-on-one effect, but it will start driving down or at least removing some of the risk premiums. So we will see have rates starting to retract, well, as long as the economic data continues to go on our side, like we've seen over the last few days. So let's get down through here the rest of this. The 10-year Treasury, that's why we focus on the 10-year Treasury. Now, how does this chain historically work? Well, we went over that, but let me kind of break down this for you historically to give you the data points so you can completely understand how all this is working. Because so many people come out on a daily basis and just say, here's what I want to show you guys what should happen. I'm not predicting it happen. I'm just saying based on history and all the data we have, here's what should happen. So, okay, let's go through how the chain works historically. Fed raises / cuts federal funds rate. Markets adjust inflation and growth expectations. Those expectations drive 10-year yields up and down. Mortgage rates follow the 10-year yield with a lag of a day or two, keeping the spread intact most of the time. Well, it's not intact right now. Historic patterns, let's go back in history because a lot of people are going to say, oh, here's that housing crash we had, 2008. Well, here's other times in history that we've seen patterns kind of similar to this. 1980s, the federal funds rate was 10. 10. And everybody's bitching right now, and I get it. I do the same thing, folks. We're at 4.5. So it was double. It was basically double where we are back in 1980, and I was alive in the 80s, folks. Okay, so let's get to the 2000s housing boom. Now, here's what happened to housing. If you really want to understand what happened to housing, just think of this as an interest rate just in general. Okay, the rate in the 80s was 10. 2000 housing boom, the Fed cut rates to 1. 1. Okay, 10-year drop, mortgage rates fell below 6, fueling demand. So that's what happened. What happened now, the post-2008 crisis, Fed did what? Dropped rates to 0. 0. QE, what they do is bought treasuries and MBSs. So what happened during this time, because the markets and bonds, they react, think of it as supply demand, okay? What the Federal Reserve was doing when they're quantitative easing, that's what you see when you see QE. That means the Fed is easing. What they're doing is trying to drive down rates. So what they do many times, especially in the mortgage market, they'll go in and buy mortgage-backed securities, and they were doing $40 billion a month. $40 billion. So think of it as we talk each day about this, the supply demand. Let's get over to this. So let's say you have a ton of people buying and the price of this bond just keeps going up, like stocks. If you have a lot of people interested in buying a stock like NVIDIA or something like that, they buy, and the price keeps going up. Well, what do we know about if prices go up on the MBS, what happens to rates? They come down. Okay, so if the Federal Reserve, they're in there buying $40 billion a month, they're just driving those rates down to nothing. I have a 30-year fixed on my home that I did back in 2021. You're going to see it right through here as well. It's 2.65%. It's crazy. I know, but let's keep going. 2022 pandemic. Fed slashed rates. 10-year yield near 0.5. Okay, the 10-year. Okay, 10-year. So again, we add 2 to that. Because that's the spread historically. Well, that's where your 30-year rate was back in these days. And that's why. Okay, so that's what we're saying right now. Inflation's spiking right now, and it has over the last few years. So now the Federal Reserve, what they do, they increase rates. 10-year yield rose to 4%. Mortgage rates top 7%. So look at the spread there. Now we got 4 and 7. That's a 3% spread. So you have to focus in on where the bond markets are taking us, the risk premiums, the spreads, the things that everything looks at. And a lot of times when I go over all my data, I'm sure most of the time you're looking at things, why in the hell is he going over that data point? Well, hopefully now you understand. Okay, so let's get to the key takeaways on this. Federal funds rate and mortgage rates are not on a one-to-one linked correlation. Mortgage rates follow the bond market, especially the 10-year Treasury. And again, when you start hearing Besson, our Secretary of Treasury, saying we don't give a shit about anything, our concern is the 10-year Treasury, and we want to drive that yield down as far as we can. I got a thumbs up. Okay, that's because it's going to help the housing market, which is basically it'll fuel the whole country. Do I want another, rally, this kind of rally in home prices? Absolutely not. It can't be sustained. I agree with you, folks. I'm a homeowner, been a homeowner since I was 23 years old, and I've always been a homeowner, and I've always made money because I've always stuck in my home for a long period of time. But I never got returns of 10, 20, 15, 30% a year. If your house went up 3, 4, 5%, I was like, okay, that's cool. It gives me a great place to live. I've always wanted a home of my own. My parents were from Italy, and my grandparents were from Italy, and everybody always wanted to own their own home. So our generations were brought up that way, and I was able to buy a house when I was a young kid. So thanks to my parents and everybody else. Okay, 10-year yield is the primary driver of fixed rate mortgages. Mortgage rate spread over the 10-year time, key watch point. When it widens, mortgage rates rise more than the Treasury yields. So that's what we're seeing right now. And then I stopped the data right there. So let's go back and see if we can conclude this. When will rates hit 5%? Well, when the federal funds rate hits 3. Okay, and it could be there next year because most of the people out there are saying, we're going to cut this by probably 100 basis points. Okay, so if we do that, where is we going to be? We'll be at 3.5. Okay, we add 2 to that, we'll be at 5.5. So we will be in the 5s. I don't think we'll get the 5% or 4.99 anytime soon, but hopefully that answers your question on when are we going to go down to 5%. And I don't think in my lifetime we'll probably be at a 3% 30-year fix, but I can never say that. You never know what's around the next corner, folks. So if you guys have any questions for me, I know I don't have the specific answer, but at least I'm giving you the guidance of what do you need to follow to figure out what's going on. So if you're looking to buy or refinance, or you're a realtor, or you're a mortgage person out there, these are the things you need to talk to your clients about so they understand. And a lot of times, here's what you're going to have reluctancy. Let's continue to talk about rates. For the homeowners out there right now, we have a RateWatch tool, and I'm not selling that right now, but I want to explain to you guys what's happening behind the scenes. On my website, I created this website, and right through here, I was like, okay, I want to ask people, because I kept getting these, when's rates going to get 5, and when's they going to drop? I'm like, you know what? Let me just create a link on my website, and this goes to an Excel spreadsheet, folks, that I follow on a daily basis, and I reached out to I think about 8 people today so far. And what I asked them to do is, I don't know when rates are going to go to 5% or 3%, but why don't you give me your data, fill it in right through here. All right, just tell me what kind of mortgage, what is your current mortgage rate, what's your home value, what's your balance, what's your credit. I can monitor this for you. Let me know what kind of loan it is. In the background, what happens is when you fill this out, I'm not selling your data, folks, because I want to keep it because I'm here to help you. Okay, when this rate hits, let's say you're at 7.5 and you're like, okay, what I don't want you to do is this. We have people with $500,000, $600,000, $700,000, $800,000 mortgages, and you'd be amazed on how many people have a rate at 7.5 to 7.75, and they're just waiting for rates to go lower and lower and lower. And folks, I get it, but if you can have a break even of 6 months or so, and you can save $400 or $500, why do you look a gift horse in the mouth? And that's why, I used to have a slogan, pigs get fat, hogs get slaughtered, and I'm starting to say it again because I'll have people in this. Then when I finally go, I'm going to coach you real estate people out there and mortgage people. Talk to your clients and say, okay, the difference in the payment is $8, and $8 is $8. I get it. But, if you're going to, instead of saving $400, you'll save $408, I don't think that's a good trade-off. So you want to, log into this system and put in your information so I can track it for you, love to do that. Also, if you're out there, here's what we want to do. And if you're a mortgage person out there, I want to kind of tell you this. We have this thing. I created this, and this is for your consumers too. But I want to be transparent to my fellow mortgage people. I'm not trying to steal your business, folks, but I'm trying to give people a good service. So here's an analysis I got last night. We created this loan estimate review link, and these are for people just to check and see, because you were taught when you're getting a rate quote, get 3, 4, 5 different quotes. Okay, well, we have a system here that I'm a part of, where when you put in your application one time, we're going to pull your credit, then we're going to shop your loan to 33 different lenders. Okay, why? Well, I want to make sure when I get back with you, I get the best quote possible, because I don't want to be beat. Okay, so what I'm going to ask you to do is go into the loan estimate tab. If you already got a loan estimate and you're closing 3 weeks out or further, let me see if we can, I'll run your loan analysis through 33 lenders. Let's see if we can help you out on your rates and fees. Now, folks, and even the realtor or my fellow mortgage people out there, dude, if I can save a client $400, $500, $600, $700 total, I'm not going to help them. Here's an example I got yesterday. I had a young man call me. He's got 6 kids. He's struggling. He's like, Dan, I need some money out. I got an FHA loan. My credit scores are pretty bad, but I just got to pay off some bills and just get out of get above water. He sent me a loan estimate, and when I got it, I usually send a video and whatever. I called this guy immediately, and I'm like, dude, what? He got an FHA quote at a 7% rate. Okay, you guys out there that are mortgage people, 7% on an FHA, 20,000 in points. I didn't even know that was legal. So I reached back to him. I'm like, even if your credit score is 560, I can get you much better than 7 with no $20,000. Those are the people I'm trying to help out, not just somebody who's saving $500. I'm not going to steal your business for that. But if somebody's reaching out to me and I can save them $5,000, $10,000, $15,000, you betcha I'm going to help them out. So that's why I ask you people, if you're watching me now and you're in that situation, please reach out to all your, if you got a couple estimates, reach out and make sure you got the best one, send it to me. I'm not going to swipe out, and pull people out of the rug. If they've already worked on your loan for 2, 3, 4 weeks and you got a good rapport, stay with them. But if you really want to check them or you're not satisfied, check out this loan estimate tool. All you do is click that, you upload your loan estimate, tell me what your closing date is. I'll either call you or do a video and send it right back to you. So, folks, that should do it. Let's get to any questions we got. Quit selling my part of it. All right, let's go down through here. What do we got, folks, for today? All right, let's go back to here. I'll just give you the rates for today. Good afternoon. So our rates getting higher or lower? Their rate today, let's see what they're doing today. Okay, so we got the PPI number coming in today. I'll do this in my closing bell. So if you guys watching this, you don't have to watch the closing bell. But here's the number we got today. I'm going to bring this up. And this freaked me out when it came out this morning. I gotta really blow that up so you guys can see it. These are the numbers from this morning, okay? Jobless claims, this was the good news. Maybe this is what the markets are reacting on. Jobless claims, 226,000 previously. It was adjusted up to 227. They thought it would come in right at 224 or 228. It actually came in at 224. So I'm going to say this is net neutral. The good news about this, remember 2 weeks ago we got that jobs report, 250,000 people were just vanished. Well, this is what I was hoping that it wasn't going to show up in, and it's not. So could that be an anomaly? It might be. Continued jobless claims. Now, this is my number one focus right now. Is this growing and growing out of control? So let's go over to here. The last reading we had was 1.974. It was updated down 1.968. It was expected to come in at 1.960. Came in at 1.953. This is a good number, folks. A very good number, because now we're seeing people are starting with the job lists. It's not piling up on us right now, so that would be detrimental. Here's what shocked me like I said, when I saw the print. Now this is core producer prices. We know core extracts out food and energy month over month. That's what you see there. Holy shit! It went from 0 to up 0.9. That's almost 1 full % in a month. You analyze that. I'm a math genius. It's 12. No, because you have compound or whatever. You understand what I'm getting at. That's not a good print. So then, getting back to where we were, what's going to go on with interest rates? Well, if you have a high PPI number, what does that teach us, especially when we go over here? That means the Federal Reserve is probably not going to do anything, or maybe maybe even increase rates. Well, we know they're not going to increase rates at this time, so most likely they're not going to do anything. So we're going to see a benign numbers there. And that's it. Producer prices, yeah, that's it. It's crazy. So that's what we're seeing there. And then when we focus in on here each day is a mortgage bond, and that's right through here. And if you don't really know how to focus in on that, I'd love to help you there. Okay, let's keep going. I'm got offered 599 20% down conventional with buy down. How much is, Antonio, how much is the buy down? That's what you guys got to be concerned. Here's a lesson I got to teach people. Don't be wowed. Don't be wowed over the rate. Remember the young man I just talked about? He had a 7% rate. Most of you saying 7% might not be that bad if it was, last year or whatever. With $20,000 in lender fees? No. Okay, so be careful. What are your fees? Don't just look at the rate and say, whoa, that's fantastic. So you got to break it all down and make it make sense. What do we got here? We got Antonio. Thank you so much. What's the next one? Sheesh. I think that one came up when I was talking about the numbers, though. Yeah, I'd have to agree with you on there. Hey, long-time listener here. I have a 7.5 rate for a condo, looking to refi next month. What's the general closing cost? You know what? Email me. I can actually break it down to the penny for you. I'll run an analysis for you. So you could, if you want to just email me here, I'll give you my email address. You could do it right through here. So if you guys have any questions for me, just reach out to me at dan@therateupdate.com. You can also go to our website. If you go to the website, I make it as easy as I can. At the top of every page is an Ask Dan. So you can just click that, and you're on the way to asking me a question. So if you've got any questions, feel free to use that as well. Let's go back to my questions. But yeah, reach out to me. I can break it down. I need to know your address. So if you could, where'd you go? I had you on the screen here a second ago. Let's see. Where are we? Okay, so yes, please, if you would, email me. If anybody's watching this and you want me to kind of give you a rate quote, and I'll break it down to your costs and everything else. What I need from you, and you can go into the Ask Dan, I need your home value, I need your loan amount, your credit score, what kind of property it is, like a single family, a duplex, is it a rental or not, and then your credit score. And then I'll get back with you and I can break it all down. What I usually break it down is no lender fees. So you don't have, because a lot of times lenders will add in $1,500 to $2,000 and they're just junk fees. We don't do that because we want to be as competitive as we can with this. So if you want to, just shoot me an email. Get off the 7.6 rate. You can drop it probably at least 0.5% or a full percent right now and start saving some money. So, don't get too greedy out there. All right, let's see what you asked me again. And what should I look for refinancing in terms of percentage and cost? Again, just shoot me an email, and I'll respond, and I'll answer every question that you have. I'll probably send it back to you in a video form so you get a little bit easier to understand. All right, so what do we got? We got Jessica. We are waiting because we only get one refinance with having to pay back our dream loan, so trying to use it wisely. We are waiting because we only get one refinance. Why, Jessica, why do you only get one refinance? I refinanced 1 year 2 times. So I don't know if you have a free refinance with somebody or something like that, so don't let those gimmicks play a role in that. So again, if you need my help with this, you want to just give me an idea what you're looking at, I can make them honest with you, because what we could do is we can compare what they're offering you with all 33 lenders we use and see if they're the best of breed. If not, you might not be getting a good deal anyways, but you might be. So check it out. Let's see what we got, bud. I'll let Dan correct, but after you can refi as many times. Oh, yeah. I agree. I appreciate you posting that on, boy. I was offered a 6.375 interest rate. No point buy downs was used. $20K in closing fees with a $20,000 in closing fees. Folks, reach out to me. These are the things that you're getting hosed with. So you might not be getting hosed. Let me say it that way. But upload your loan estimates right here. You got nothing to lose. If I can't beat it, what I'm going to say, like let's say you're getting a 6.3% rate and I'm at 6.3. They're charging you nothing and I'm charging you $5,000. I'd be the first one to say, take it. Take it. I'm in your shoes, folks. I'm not here to put anybody else in a bad position. I'm here to help. So, okay, so that's that. Sorry, I get pretty worked up on some of these things. This is a conventional with 5% down. Okay. But there's more to the equation, like I said. So please go to the rate update, hit the Ask Dan button, and shoot me anything, so I can give you personalized service and really drive it down. You might be getting a fantastic deal, or you might be getting just clobbered. So let's just let's put it this way. Let's check it and at least give you a peace of mind that you're they're putting you in a good position. If they're not, I'd love to work with you. If they're putting you in a good, I'll be the first one to tell you as well. Just saying that offer is awesome. So, and trust me, I do that all the time. I had a young man call me yesterday, and here's what it was. He's buying a $1.6 million home. He needs a $1.2 million loan. You guys loan officers don't know how much money you can make on those. And here's what he told me. He came in, we talked last night, and he said, my loan officer's been working on this for months, and he's been helping me in this and that. I could save him $3,000 in costs. He's like, is it really worth $3,000? And I'm like, you know what? Go back to your loan officer. They put way too much work into this, and I don't want to ruin their livelihood. You know, it is $1 million loan. The guy's, he's a physician, makes a lot of money. God bless him. You know, and I'm not here. If I was able to save him $20,000, $30,000, $40,000, yeah, I would take that deal and work on it in a heartbeat. But I'm not here to. I'm here to help folks, and that's it. Okay, so that's that. So check out, reach out to me and see if I can help you out on that one-time refinance that you're offered. Just text you a great setup. Thought you would like. Okay, I will check. I don't see any texts, but I will see. All right, let's see what we got. Current $500,000 conventional loan. I had 20% down, 790 credit score, 6.8. Can you beat par rate? Well, here, let's do it. Well, we got you on the phone, or we got you on the hook. I'm going to go to my sifters. Let me do sifter on another screen, because if I put more and more stuff on that screen, I'll lose everybody. So what I'm doing now, I know, folks, I'm looking the wrong way, but I have if you ever join me on Wednesdays with Alan, we go over that, how we compare your rate to over 30 different lenders. I got that on this screen over here, because if I put it on this screen, there's way too, I can't organize myself up there anyways. Okay, so let's see, we got, I got to put my glasses on, folks, I'm old. Vaj, I'm going to call you Vaj. Sorry, no disrespect, but it's just the easiest way to do it. Vaj, let's see, we got a conventional loan, current had 20% down. So we're doing a refinance. Let me know when I turn my head, if you guys can still hear me. I knew that was an issue before. Property value. Current loan. Oh, 20% down. So let's go 500,000. I'm just going to say you still need 80% loan to value. And we have a zip code, 95742. 95742. I hate to ask you this, but what is I'm not going to ask you. I need you to know if your monthly gross income, but I really don't want you posting that online with people seeing your stuff up there. So don't do that. Let's just see where this takes us. Your credit score is 790. Fantastic. Zip code. Got 6.875. Can you beat par rate? Let's see what I get. And again, how much are you paying for that? But let me tell you what I can do. Right now, I am at 6.5% with no lender fees, points, discount fees. The only thing you would have is an appraisal. Possibly, you might even get an appraisal waiver, and your title fees. So right now, I would be at 6.5 with appraisal and title fees. If you're interested in doing anything, just go to the rateupdate.com right through here, and I'll show you how simple this is. And your loan will actually come to me, and you guys have probably been introduced to Alan. He's been on our show a few times. Just go to the rateupdate.com and hit this button right through here. It's a really simple system, folks, too. We hand chose this one because it's a nice questionnaire kind of feed through that process. So hopefully if you like the numbers, 6.5 with no fees on that, you can go ahead and click that and get moving forward. All right, so let's see what we got there. What is the lowest rate you've seen? I have 5.9 on a 500,000. I got one today. So it was a young lady who's looking to buy a house, and it's an FHA loan. And I run the numbers, and I'm like, you got to be kidding. It was just about an hour ago. And it was par rate at 5.99. So the par rate means you're not paying any discount points, but you're not getting any credits. That's our true rate. And then from there you have like credit appraisal, things like that. But we don't charge you points, underwriting fees, all the admin fees, all the junk fees like that. So hopefully I answered that question for you. Let's see what the next one we got. $330K with 20 down conventional. Antonio, I need to know a lot more, Antonio. Here, let's get back to you in a second. Dream for All programs only give you one refinance with having to pay back the I get it. Yes, you are right. So I would wait a little bit. Again, I always say pigs get fat, hogs get slaughtered. You're probably in maybe California or an area like that. So I get it. And that's a big chunk. What's happening a lot of here's what happened with this person is they took a down payment assistance program, or let me just generically tell you what's happening with a lot of people right now that took the down payment assistance programs. That usually the ones we have, or almost all the ones we have, there's no payback, there's no lien, and the reason why we do that is this: we're not looking short term for you, we're looking long term. Okay, so here's what's happening to a lot of people that bought last year and the year before. They took a down payment program. Let's say it gave them $10,000, $15,000 in assistance, but it was a lien on their home. Well, the problem with that lien is when you go to refinance, you have to pay it off. So that's going to add another $10,000 or $15,000 to your loan amount because it was basically sitting there on the sideline, not doing anything. Some of them have an interest rate, some of them have payments to them or whatever, but you're going to have to pay those off. The ones that we promote, and we don't have a lot of them, but they were basically I'll call it free money because there's no lien on your home, there's no payback, and the nice thing is that when you go to refinance in the future, you have nothing to worry about because think if it was a $10,000 or $15,000 or $20,000 down payment assistance programs. Well, if you go to refinance because you're at 8%, now you have to pay another $20,000 on your payoff because of that down payment assistance loan. It can make things really squirrely, and a lot of people aren't qualifying because of their loan to value. So that's the problem. I'm not saying home prices went down. I'm just saying you packed on another $20,000 on top of the loan when you go to refinance. So hopefully that makes some sense to you guys. Okay, we'll pay $74,000 closing fees in all. 6,600 seller credits, 3K earnest money. Antonio, here's what I need you to do, buddy. This is the best way to do it. Email me, and I'm going to call you right after the show. And my email is right through here. And anybody, I usually don't ask people. I usually don't say I'm going to call you right after the show. But Antonio, I'll call you after the show. Anybody else, if you need some help, here, hold on, let me get you my if you need some help, please just go to the rate update. You can call in. You're going to get Alan. If you ask Dan, you're going to get me. And then if you put in your application, you're going to get me or Alan. So basically that's it. All right, folks. Well, I took up enough time of your day today. So hopefully I kind of answered the question on when will mortgage rates go down to 5%. It depends. It depends on a lot of stuff. And the most important thing you can watch is the 10-year Treasury, consumer inflation, the jobs reports, and just the overall markets, and see how they're faring for the day. So if you have a good economy, things seem to be rolling okay, you're going to have an okay market. You have really volatility, or you have catastrophic events like the COVID, you're going to have volatile times, and those times, the good times lag throughout. It takes a while for the data to lag through. So hope you're in a good position right now, folks. But if you do need our help, if you're looking out there and just trying to kick the tires saying, okay, does this make sense? I'm just like you. I'm a dad, I'm a parent, I'm a husband. I work all day long, and I'm not here to rip you off. I'm just here to help you in any way I can make sense of all these matters. So hopefully you understand and learned something today. I hope you did. Who's this? Who do we got here? We got one last question. Nick. Looking to refinance. $800,000. I want to give you guys a kudos, because a lot of comments I get in my YouTube channels and down below, not from you guys probably joining me here today, are I have no money, I have terrible credit, nobody can ever buy a home, the world's going to end, and all this other stuff. That's why I even created Stock Talk Tuesday, folks. I got nothing. I'm not even a stock person. So I'm just trying to advise you guys or help you guys out. But I love when we have our viewers come in buying an $800,000 house, buying a $330,000 house, buying this. It's awesome to see, people are being productive out there in the economy. So let's get back to you. Looking at refinance, 805. Value is now 910. Current rate is 7 with no PMI due to it being physician's loan. When would it make sense to refinance? Let's see what we got here. You know what? If you, Nick, because you're probably in a high cost area, 805 is going to put you over some parameters. And I don't want you to expose all your data on here. If you'd be another person, if you don't mind, and I hate doing this, if you could shoot me an email, because I don't want you posting your data all over this website, because there's more data I need from you. But I'd love to dig down into this. 805,000, even 0.5% in the rate would save you a lot of money. So might be prudent just to shoot me an email. I'll give you a phone call here after I talk to, I think it was Antonio is the other person that's going to email me, and I promise you guys I'll call you right after this show. So other than that, folks, I hope I answered the question. The 5%, is it down the road? It might be there a year or two from now. Are we going back down to 3? Well, per Yahoo Finance, Dan Frio is saying no, and not in his lifetime. So hopefully that resolves those questions for you, folks. So that's the end of my show for today, folks. I greatly appreciate you watching and joining me, because without you being here, I'd be sitting here talking to myself. So if you have any questions, please shoot me an email. Ask me questions on my YouTube. Don't post down below on YouTube. I used to try to keep up on those and answering every question on there, but some of them are so rude, I quit doing it. So if you really need me, just go to our website and ask Dan, or shoot me an email, folks, and I'd be more than happy to help and respond in any way. Take care.